how does the Fed actually impact our money and our investments?
There's a lot to that, but the Fed really is pulling all of the big levers that control our economy and control the markets. So the Fed doesn't directly set interest rates for everything. They set the overnight rate that banks loan to each other, but that directly influences the cost to borrow for everything and everyone. So, personally, to buy a home, a car, if you want to get a student loan, to pay for whatever you use credit cards to pay for, because there's an interest rate, that's actually personal borrowing. So, it influences all of those rates. I mean, if you just look at what's happened with mortgage rates are sitting at over 7% right now across the country for the 30-year mortgage. Just 3 years ago, or just, 2.5, 3 years ago, mortgage rates were at 3%, actually a little bit under 3%. So, the Fed sets rates. They don't set mortgage rates. Banks and lending institutions
Yeah.
do that, but they do it based on what the Fed is doing. And if you just look at, not only have interest rates increased, but average home prices have increased too. I was looking just this morning, and back in 2021, just 3 years ago, the average home price was $418,000, and the average mortgage rate was about 3%. Let's just say. Now the average home price is $492,000. That's up 18%.
Wow.
And mortgage rates, if you could even get a mortgage right now at 7%, what you're looking at, the difference in monthly payment, not even considering your taxes and insurance, someone looking to buy the average priced home now would be experiencing a $1,500 a month increase to their note. So definitely this impacts us on a personal level. Car prices have increased tremendously, but so has the average interest rate to buy a car. And it's not only the cost to borrow, it influences our investments because companies use debt. They borrow money for operations. They borrow money to grow and expand their businesses with the thought that, if they invest in their business, they can hire more people, which contributes to a growing economy that they can. Those consumers now have steady jobs. They have increasing pay, so they're going to spend more money, so on and so forth. And when the cost to borrow goes up, a debt-heavy company's expenses increase because their interest rates go up. It costs more money just to service the debt that they have. So if those costs to service the debt increase more than its revenues, then profit margins shrink. So that makes stock prices go down. The same thing happens with our government. So you're seeing how what the Fed's doing, increase in costs can influence companies and the economy. It's the same thing with our government. The cost of money has been near 0% for decades until 2022 when the Fed increased rates 11 times, and our government has loaded up to the tune of almost $35 trillion in debt now. And it's become more and more expensive to service that debt. So you may be thinking, what does that even have to do with me? Well, we're approaching $1 trillion a year just to service the debt that we have. And this is mostly debt that we put on the books when the rate was 0 to 2%. If you look at revenues coming in from taxes and the current cost of servicing that debt, we're spending about 17 cents out of every dollar that's collected in taxes right now just to pay interest on our debt. So the government's revenue comes from taxes. Taxes are going to have to go up to try to keep up with just servicing the debt.